Hey everybody, welcome back to the Financial Freedom Show. My name is Rob Berger. In today's episode, going to talk about whether it's a good time to invest right now, or should we kind of wait until all of the bad things in the economy we think might happen actually happen, kind of let things shake out, become a little less, interesting, and then invest. It's a question that I've received from a lot of folks recently, so I want to address it. And as we walk through this, I think it's important to distinguish between two different kinds of investors. The first is, I think for many of you, you're dollar cost averaging, you're putting money into your 401k every paycheck, maybe into an IRA once a year or once a quarter. Perhaps you're investing a little bit into a taxable account, but you're just sort of month by month investing some money compared to someone who maybe you've come into some money, you've inherited some money, you've gotten a big bonus, and you've got this big lump sum amount that you want to invest and you're scared to pull the trigger right now. I've had a number of people email me with that situation. It's really important to understand that those two types of investors are in very, very different situations, as you'll see. So let's get started. The first thing I want to kind of do is to say, you're right to be concerned. There are a lot of indicators right now that suggest we could be in for some rough seas ahead when it comes to investing. I want to show you some of them. The point here is not to scare anyone, but at the same time, we don't want to stick our heads in the sand. We want to deal with reality. So let me show you a few things to begin with. This is the S&P 500's price to earnings ratio. This is on the multiple.com website. They also track this what's called the Shiller PE. But when folks say that stocks are expensive, there are a number of different ways you can measure it, but one of the most common is price to earnings. So you can think about it as the cost of a share of stock in proportion to the earnings per share. And right now, as you can see, it's not the highest it's ever been. In fact, it was even a little higher recently. And of course, we can go back to the 08-09 financial crisis where it jumped briefly off the charts. And then we go back to this time, the tech bubble. But, still today at 34.61, when we go up back over the last more than 100 years, stocks are extremely expensive. And you can look here, by the way, here's the Great Depression, right? And the stock market crash of 1929, the Great Depression. The stock market today is much more expensive, at least based on the price to earnings ratio, than it was even back then. That's the first thing. The second thing is that bond yields are extremely low. This is the 10-year Treasury yield. The data goes all the way back to the 60s. Those old enough like me can remember when the yields were in the double digits, but they've since basically steadily come down over the last 40 years. They were extremely low when we were first dealing with COVID last year. But even today, they bumped up to about 175 basis points roughly. Today, they're around 120, I think, 124 as of a couple of days ago, a couple of weeks ago. So right now, I think it's around 120. But the yields on bonds are extremely low, which means two things. One, we're not earning much on our bonds right now. And two, if rates start to go up like many people think they will, the value of our existing bonds are going to go down. So that's sort of, we got expensive stocks and we have expensive bonds. And, not to be too depressing, but let's look at the current U.S. debt. This is the debt clock. There's a couple of different ways to actually measure the debt, but I think this is probably the most common. And yet you can see it going up a lot as we record this video. And it's at 27, I guess almost 28 trillion. And we can see that it's gone up significantly since the 70s. And obviously it's gone up quite a lot in the last couple of years. And to deal with that debt, the Fed, of course, has done everything it can to keep interest rates low. This is a recent Wall Street Journal article from June of this year. And they talk about how the Fed has bought, you can see here, they've bought $982 billion of, this is just mortgage bonds, since March of 2020, right? And they're buying $40 billion a month, $40 billion a month, right? And that doesn't count, you can see the next sentence, $80 billion of Treasury debt. So the Fed is buying as much debt as it can. And what that does, it has the effect of one, putting a lot of money into the economy, and they're working very, very hard to keep interest rates low. So I go through that somewhat depressing series of websites to show you, not to freak everyone out, but just to say, yeah, we are in unprecedented times, and I think it's justified that we should have some concern. Now, that then raises the question, though, what should we do? Should we invest now, or should we wait for some time in the future? And as I mentioned at the start of the video, there's a big difference between someone who's got a lump sum they want to invest and someone who's just investing sort of on a dollar cost averaging basis month to month, say in a 401k. And I want to actually show you that with the numbers. So what I want to do is look at a portfolio, and we're going to first look at the lump sum scenario. We're going to just assume $100,000. Of course, the number could be whatever in your case. And we're going to start in 2000, and we're going to put all the money in a U.S. large cap, which is effectively an S&P 500. Now, why did I pick the year 2000? I could have gone, all the way back to 1972. I picked 2000 on purpose, and here's why. If we go to a chart of the S&P 500 return, we can see that in 1999, market had a good year, up almost 20%, and then we have basically the tech bubble starting to implode. In 2000, it was down 10%. 2001 was down 13%. 2002 was down 23%. So I want to pretend like we picked the absolute worst time to invest, or one of the worst times to invest. What would happen? Well, we could run the numbers. And what would happen between January 2000, you can see the time period here, and July of this year? 100,000 would have turned into 442,000, compound annual growth rate of 7.13%. Certainly not awful, but one thing I want to show you is here's our running total through the years. And it's interesting, we can fast forward all the way to 2011, and we still have less money than we started with. An entire decade went by. Again, we're assuming a lump sum investment. You'll see that's really important. But more than a decade went by, and we still have less money than we started with. That's a hard thing for an investor to stomach. And of course, since then, it's done quite well, and we can see, and of course, even since COVID, it's gone up quite a lot. And that's kind of saved us, over that now 20-21 year period, it's a reasonable return. But here's the thing, if we knew ahead of time that the tech bubble was going to crash, we might say, well, we're going to wait and put in our lump sum, not in 2000, 01 or 02, we'll wait till 2003. What would that do to our 442 number? Well, we can find out. We make 2000, 2003. We reanalyze the portfolio, and of course, our 442 becomes 709, and we're much, much happier. Now, that raises the question, though. Yeah, we had the benefit of hindsight, but what do we do now? We don't know what's going to happen right over here, right? Are we going to have another 3 bad years? I'm going to come back to that and tell you how I think the factors you should think about in analyzing the question for you if you're a lump sum investor, and what I would do if I were in that situation. But before we do that, I want to come back to these numbers, but we're going to change it. We're going to go back to 2000. Remember, that had been the bad year to start, but we're going to assume we've only got $1 right now, and we're going to contribute, we'll call it $250. We're going to do it monthly. We've got that right here, and we're going to adjust for inflation. So this is the idea here is, this isn't someone with a lump sum, but it's someone who's just investing each month. I've started with an initial amount of $1. You could be in your 30s or 40s and have 100,000 or $1 million, but you're still just dollar cost averaging month to month. All right. So if we analyze this portfolio, again, this is from January 2000. So remember, it's just before this terrible market. What does our portfolio look like? Well, let's see here. Again, we've got $1. We've contributed $250 a month. We're adjusting it for inflation, and our money grows to $306,000. Now, remember that number, 306. Let's do the same thing. Let's skip the bad years. We're going to skip 2000, 2001, and 2003, or we're going to start in 2003 because that was the first year that went positive, right? There we go. So we're going to start there. Remember, when we started in 2000, we had 306. When we analyze this portfolio, our 306 drops to 237. So with a lump sum, we wanted to wait past the down market and start in 2003. But when we're making contributions, we don't want to wait. If we wait, even if we know the market's going to be terrible over the next 3 years, our final balance would have gone down if we waited. Why is that? Well, one, we're investing more money. We were putting $250 a month aside for 3 extra years, 2001 and 2. But also, yes, the market was crashing, but that meant each of our monthly $250 investments was buying more and more shares at lower and lower prices. Because we were contributing to our investment portfolio during these bad years, we were basically buying stock on sale. With a lump sum, we didn't. We weren't buying. We were just sticking the money in and just letting it sit there. But when you're contributing month to month and stocks go down, you're actually buying stocks on sale. In fact, if you're still in the accumulation phase and you're contributing month to month and you've got whatever, a decade to go before retirement or 20 or 30 years, you kind of want stocks to crash. I mean, really, you'd like them to just go way down and stay way down for as long as possible, and then they then come up when you're ready to retire, because you're just going to be contributing money, at lower and lower prices. So this gets us part of the answer, at least in my view. If I'm dollar cost averaging month to month, I'm not retired yet, and I'm just saving, I'm going to keep doing it, even in today's market. And if the market crashes over the next 2, 3, 4 years, that's great. I mean, it may seem painful and my balances might go down, but if I continue to dollar cost average, I'm getting in at lower and lower prices. So having said that, let's return back to our lump sum investor. What do we do? Because we do know the timing of that lump sum when we invest it can make a difference in our overall outcome. So here's the deal. A lot of folks have done studies on whether you should do a lump sum or say spread it out over 6 months or perhaps a year or maybe even 2 years. And what they found is, on the whole, you're more likely to be better off if you invest the lump sum. Now, why is that? Well, when they look at stock markets, in fact, we can go back to the screen for a moment. We can look at the S&P 500. You can see there are a lot more green bars when the market was up than there are red bars when the market is down, right? And this is going back to what, 28. And so it's basically just playing the odds. The odds are more likely that in any given year the market is going to be up than it is going to be down. But, and this is really important, there is absolutely no way to know in advance when you're investing a lump sum what the best approach is. We can certainly choose to play the odds and say, yeah, the market's up more often than it's down, but that doesn't mean it's going to be up the year we happen to invest a lump sum amount of money. And so it's really important to understand that no matter what you decide to do, there's no way you can know in advance with any certainty whether your approach is going to end up, frankly, creating more wealth for you than a different approach you could have taken. That's the first thing. The second thing is, and one of the criticisms I have of many of these studies is they look at long periods of time, and that's helpful to a point. But what would really be nice is if we saw studies that dealt with periods like this, when stocks were extremely expensive. Studies don't tend to do their analysis based on the PE of, say, the S&P 500. When the PE is that high, I think it's fair to say that while that won't predict what next year's market is going to do or this year's market, it certainly probably increases the likelihood that we're going to have a down market. You add to that really low treasury yields along with growing debt and a lot of Fed buying treasuries and mortgage-backed securities, and inflation starting to tick up, suggesting that maybe the Fed might pull back on some of that bond purchasing and even start to increase interest rates, maybe not this year, but next. I think it raises at least a very real concern that while on the average, investing a lump sum is better, in this particular environment, I'm not so sure we can reach that conclusion. So having said all of that, what would I do if I had a lump sum? I did have a lump sum to invest in 2018. Believe it or not, that was a very different time, even economically. At the time, we thought the market was really rich then, but nothing compared to the circumstances we have today. I chose to invest the lump sum, and that's generally, I think, how I would approach it, recognizing that I can't predict the future, and I don't know which way is going to end up being best. Having said that, if I had a lump sum to invest today, I would likely choose to spread it out over probably 12 months, maybe 18 months, probably no more than 24 at the extreme. And I would do that basically because of all of the factors I've already described for you. Stocks are extremely expensive, bonds are extremely expensive, our debt keeps going up by significant amounts, the Fed's buying bonds, I think, could create inflation. I would probably today spread out the money, probably over 12 months for me, but I could see others maybe picking a slightly longer period of time. And here's why. It's not because I'm confident that will lead to a better result. It's very possible that a lump sum investment today could lead to the better result. I have to recognize that I don't know the future. However, there's this sort of behavioral aspect of investing, and I think it would be hard to deal with putting the lump sum in now and then seeing the market absolutely crater for all of the reasons we've described. That would be probably more painful to me than putting it in, say, dollar cost averaging over 12 months, even if in hindsight I realized I would have been a little bit better off had I lump sum invested it. So that's my thinking. If you're dollar cost averaging, you're putting money in a 401k, I see absolutely no reason to stop. I continue to contribute to a 401k. And if the market craters, well, each month I'm just buying more and more shares at lower and lower costs. That's terrific. If it's a lump sum to invest, most of the time, I personally would just put it all in at one time. That's what I did in 2018. Today, I might feel more comfortable spreading it out over some period of time, maybe 12 months, maybe a little bit longer. Again, recognizing there's no way to know in advance whether that's going to be the best approach or not. But given all of the difficulties and the expense of the market, expense of the bond market, I think it might just make me a little more comfortable today to take that approach. That's my take. Hope that's helpful to you. I know a lot of folks have been asking this question. Really important to distinguish between lump sum investing and dollar cost averaging. Very, very different types of investors. If you have any questions, leave them in the comments below. We'd be happy to help you out any way I can. And until next time, remember, the best thing money can buy is financial freedom.